Okay, morning everyone. Thank you for joining us for this morning's research morning call with Guang. Today we have quite a lot of counters to cover. So yeah, without further ado, I'll just begin. Okay, first of all, is DBS results from 1.5 weeks ago. Okay, first of all, DBS has done pretty well during this quarter. We see that actually they have recorded record income of more than $4 billion in the quarter. And then for their pre-provision operating profit, you can also see it's also at a record high of $2.48 billion with growth across all the business segments, as we can see on the screen. So income, we see that net interest income actually grew 7.4% year on year on a relatively stable net interest margins. So we see that for the first quarter, there's a 1.86% NIM versus 1 year ago where it was 1.88%. So this is quite commendable despite the interest rate cuts in March that we observed. But moving forward, DBS did say that the pressures will start to come in. Loans also grew 4% year on year. And next up, we have the fee and commission income, which is also see some strong growth, 14% year on year, which is propelled by wealth management fees and loan related fees, as well as investment banking fees, which actually jumped 64% year on year, despite the whole market conditions being poorer. So this really shows that their investment banking franchise is still one of the best among the local banks. Among other non-interest income actually grew 39.3% year on year, as we see some investment gains were actually realized on their fixed income assets during the quarter. But they do have some other investments from fixed income that they are holding just to tide through this period as they get their recurring coupon. The second good thing about their results was that they actually announced their interim quarterly dividend, which was maintained at 33 cents, which based on current price of around $20 represents an annualized yield of roughly 6.6%. And for the upcoming ex-dividend date, which is actually tomorrow, there's actually 66 cents of dividends that will be ex-date tomorrow. So DBS did guide for upcoming dividends to be more guided by the stability in that lump sum of 33 cents rather than a payout ratio. So as and when they are able to sustain this payout, they will try to keep it stable. Okay, so for the negatives, what we see is that of course everything for the banks this quarter is about their allowances. So for DBS itself, they actually had 1.09 billion in allowances, which put a very huge dent on their earnings. So a total of 383 million was charged to their specific provisions due to new exposures recognized during the quarter, which includes one of the large oil traders that we see in recent news. Apart from that, there's also 703 million in general provisions, which were charged in anticipation of a deeper and more prolonged economic impact as a result of the pandemic. So right now, their cumulative reserves for GP is actually $3.2 billion. So that supposedly this will help them tide over the next few quarters as they continue building. So you will see this 3.2 billion continue accumulating over the next few quarters as well. In terms of the outlook, we see that DBS has guided for credit costs to be of 80 to 130 basis points to be incurred over the next 2 years. So there is a total of $3 billion to $5 billion in allowances added per year, not per year, sorry, in total over 2 years. So in a year itself, it should be about 40 to 65 basis points. So just do an even split. Then there's also a downward NIM pressure to kick in subsequently as more pressure is being felt. In terms of investment actions, we actually maintain our accumulate call with a lower target price of $20.60. We are expecting an allowance of 700 million per quarter to be booked over the next 4 quarters. So until first quarter of 2021 still have, and for the NIM to be further reduced by 10 basis points. Next, I talk about UOB. So in comparison, UOB in terms of business momentum wise is coming off a bit weaker compared to DBS. However, we still see that fee income continues to enjoy business momentum from previous quarters. So wealth management fees were also up 28% year on year, which boosted some of the lower loan related fees, which is minus 11% year on year. Secondly, we see that actually for UOB itself, the earnings impact from allowances was actually quite muted compared to the other 2 banks. So first of all, this was because they actually used their RLAR, which is a regulatory allowance. So a total of actually for the first quarter, UOB actually charged 546 million in total allowances, which is catered for capital reserves, but 286 million was charged through the SP and GP, sorry for the mistake on the screen. So it's both impaired and non-impaired loans, total of 286. But they actually took on a 260 million additional charge on their reserves through the RLAR from retained earnings. So it doesn't actually show up in the P&L. So currently, their cumulative GP reserves actually stand at $2.3 billion, which are actually inclusive of 400 million in management overlay. So in that aspect, $400 million in management overlay means that the management actually caters for more than sufficient of what their model is actually showing. But of course, in the current uncertain times, they are always expecting more than what their normal rate is. So yeah. In terms of the negatives, we'll see that one part of it is that the net interest income actually fell 8 basis points year on year to dampen the net interest income. So this is despite a healthy loans growth of 3% year on year. We see that their net interest income didn't grow, but actually it held stable as the NIM fell actually 8 basis points from 1.79% to 1.71% from a year ago. So moving forward, this pressure will be felt even more strongly. In terms of the outlook for UOB, so what happens is they are actually trying very hard to balance between the stakeholders' expectations. So what we see is that we know that the additional 260 million charged to GP by the RLAR actually boosted the impacts on earnings. So by bolstering their earnings, what they are trying to do is to hold up their CET1 levels so that it doesn't fall below their desired levels of 12.5% to 13% as we move along. So they also don't want to disrupt their business operations too much as their credit quality, if their credit quality actually worsen and they cannot lend out as much as they would like to under their own business imperative as well as the government's instructions. And we see that also credit costs, they are expecting credit costs to rise over the next 2 years at about 50 to 60 basis points per year, which will amount to about $1.5 billion per year. So this may be backloaded for this year itself, as first quarter they only charged about 36 basis points in credit costs as a result of transferring some of them through the retained earnings instead of the P&L. In terms of investment actions, we are currently still also maintaining a accumulate call with a lower target price of $20.70. So expected allowance of 350 million per quarter was booked over the next 2 years, and the NIM was also reduced by further 10 basis points. So for the third bank, OCBC, which was out last Friday. Okay, for the positive itself, net interest income actually grew 6% year on year as the NIM was held stable. So this is the best among all the banks. So all the banks actually felt some compression pressures, with UOB suffering the most, 8 basis points from a year ago, whereas OCBC actually held stable at 1.76%. Loans grew to 3% year on year, and they did say that the CASA ratio actually improved from 47% to 51%. So when the CASA ratio actually increases, people are placing more cheaper funding with the banks. So that's how they can manage their net interest margins as interest rates start to come off. So we also see that fee and commission income actually also grew 10% year on year. So wealth management fees actually grew 32% year on year, and this kind of resonates with the trend we are seeing among the other two banks as well. So wealth management in the first quarter seems to be having quite a good performance all around. But moving forward, as liquidity crunch starts to kick in the market, we might see wealth management starting to taper off. And for OCBC itself, the brokerage and fund management fees actually also grew 18% year on year. So we all see that market is quite volatile, and this has attracted a lot of investors. So this is one of the reasons why the fees have grown in this quarter. So all this healthy growth has helped to stave off some of the decline in some loan-related fees in the quarter itself. Okay, for the negatives itself, for OCBC all along, it has been for Great Eastern contribution. So in this quarter particularly, we see that Great Eastern's contribution plummeted by 94% year on year. So this is largely a result of their mark-to-market losses in their investment portfolio as a result of the poorer market conditions, as we see that the sell-off was the deepest in March itself. Yep. So however, if we remove this result of mark-to-market losses, which are all unrealized. We see that the franchise actually continues to grow operationally with the new business embedded value up 15% year-on-year, and the total weighted new sales up 21% year-on-year. So in a sense, their business momentum is strong, but unfortunately, because of the investment climate, their funds have fallen. And secondly, for them, the exposure to the oil and gas industry actually contributed to much higher credit costs for the quarter. So in the first quarter, of the 657 million in total allowances, 275 million in specific provisions was charged due to mainly to a large exposure to a local oil trader. If they had not incurred this one single exposure, they said that their SP for the quarter might have totally almost close to nothing. So yeah, and right now we also see in the news that there is a suspected case of a second case of an oil trader that is coming under some adverse news. In that sense, however, the new name that has floated up in the news right now is much lesser exposure, because the total lending that was given to the oil trader is about $200 million, and HSBC is actually the biggest lender to them at 50 million. So of course the impact will be smaller, and hopefully for OCBC itself in the subsequent quarters, the contribution as a result of the oil and gas industry will be much lesser. In terms of outlook, we see that for OCBC itself, the earnings will continue to swing to the tune of Great Eastern's performance. So right now, you know that market volatility will dictate the performance of Great Eastern. So if it goes up in this quarter, the next quarter they might have some mark-to-market gains. Then in the subsequent quarter, if it goes down, it will go down again. So in terms of the impact to OCBC earnings, it's actually quite a big portion of it. So however, we also see that for them, they actually front-loaded some of the provisions in the first quarter. So we see is first quarter allowances of 657 million represented about 86 basis points in credit costs. So this might mean there might be some lesser credit costs being charged to them in the subsequent quarters heading into financial year 2021. But for 2021, that is another ballgame altogether. So we all trying to understand what happens in 2021 when the loans moratoriums end. Lastly, for them, OCBC actually maintained their CET1 ratio at a very healthy level of 14.3%, up from 14.2% a year ago. So if you want to compare it to UOB and DBS, DBS actually held it at about 13.9%, and UOB was held at 14.1%. So for OCBC to be able to hold at 14.3% is actually quite good, because considering how much allowances they actually provided for the quarter, and they did, it did fall off from the highest point at 14.9% the previous quarter. But because last year, I think everyone was still talking about to OCBC, why not start to give out more dividends? But in this time, when you see that so much uncertainty is in the market, it is good that they had this 14.9% buffer, and now that it dropped to 14.3%, it is still maintaining at a healthy level. So for OCBC, we are still also having an accumulate call with a lower target price of $9.14. So the expected allowances of 300 million per quarter subsequently will be booked over the next 2 years, and for NIM to be reduced by 10 basis points. And that's it from me for the banks. I'll now hand the time over to Natalie, who will be talking about Frasers Centrepoint.
Hi, good morning. So quite a few results from me today. We'll start off with two of our retail REITs, Frasers Centrepoint as well as CapitaLand Mall Trust. Then after that, CapitaLand Commercial Trust and Ascendas REIT, Ascott, and then finally CapitaLand Limited. So I think I'll just start off by caveating that we are moving a lot of our prices downwards, and this is largely to reflect the rental rebates given to the tenants, especially for the retail malls. That means your Frasers Centrepoint Trust as well as your CapitaLand Commercial Trust, CapitaLand Mall Trust. And we are also shifting our cost of equity assumption. So we are raising it, and part of the reason is to incorporate the higher market risk that is current in this economic cycle. So starting off with Frasers Centrepoint Trust, this is their second quarter results for 2020. All in, the thing to note is that they have retained a significant portion of their distributable income, half of it to be exact. So $18 million has been retained, and this results in a DPU falling by about 48.8%. So on the positive side, most of their leases have been renewed. So outstanding leases to be renewed for the year is 11% of GRI. For the leases that have been concluded, they actually managed to secure positive rental reversions of about 5%. However, due to the current weaker retail outlook, positive rental reversions may be a bit of a challenge. On the negative side, tenant sales for the second quarter was down by 2 to 10%, and 10% attributed to larger malls. This is due to shoppers trying to avoid crowds. So that's the reason why larger malls actually took a bigger hit. However, this 2 to 10% is considered quite muted if you compare it with their peers. For example, Suntec REIT, where tenant sales actually fell by 20.2% in Q1, and OUECT, where their Mandarin Orchard Singapore asset, Mandarin Gallery asset has actually fallen, tenant sales have fallen by 30 to 40%. So portfolio occupancy fell slightly by 0.4 percentage points due to 2 non-renewals as well as 1 pre-termination. So in terms of tenants asking for rental rebates, FCT has not received much of these requests, partly attributed to the 2 months of rent-free or rather rental rebates that were given to their tenants. One month is actually from the property tax rebate from the government, and another 1 month is from FCT's pocket. This could be the reason why there have been very little rental requests for rental waivers. However, there's a risk that this number could rise once the tenant rebate periods are over. So overall, we still maintain an accumulate for Frasers Centrepoint Trust with a lower TP of $2.24. So this actually gives us a yield of 5%. Our DPU is cut by 11%. This is due to the one month rental rebate from FCT's pocket. Okay, so moving on to our next counter, which is CapitaLand Mall Trust. So for CapitaLand Mall Trust, we are upgrading them to a buy at a target price of $2.22. This is their 1Q results update. So they have shifted to a half-yearly reporting. Gross revenue was higher by 6%. This was due to the contributions from Funan that was reopened in June of 2019. However, on a comparable mall basis, the revenue was actually down by 2.2% year on year. So same thing that we see for FCT, they have actually also withheld some of their distributions to the tune of almost $70 million in 1Q. This is to ensure that they can fulfill any cash flow obligations in the following quarters to come. So DPU actually was slashed by 70% to 0.85 cents. On the positive side, similarly, most of their leases have been renewed. So 1/3 of the leases renewed in this quarter had average reversions of 1.6%. This is lower than FCT's 5%. Currently, about 11.9% of leases by GRI remain for the year. On the negative side, tenant sales for first quarter was down by 7.5%, largely representative of the whole portfolio. So for the top 5 trade categories, tenant sales actually fell by about 6.5%. We also were informed that there were some pre-terminations at Clarke Quay. And this pre-terminations was a low single digit of NLA from a mixed basket of trade categories. So this is about as much information as we got from CMT. So in terms of tenant support or tenant relief, CMT has committed to $114 million worth of tenant rebates, inclusive of the 1 month property tax rebate. 100% property tax rebate from the government. And so this will cover 2 months, April and May, for most tenants. And on average, CMT collects about 3 to 5 months of security deposit from tenants. However, they did allow tenants to draw down on 1 month's security deposit in March. So that means if the tenants have drawn down on the 1 month, that leaves about 2 to 4 months of security deposits as a safety net. One thing about CMT is that they did mention that there might be higher risk. They are prepared to allow higher leases with higher risk sharing component moving forward. So while this might actually cause more variable revenues for the REIT. It also will help with the demand side, the demand for spaces, in the sense that tenants may now find it more economically viable, especially for new to market brands, to give the brick and mortar model a go. So they have actually tested this out with Funan, where 30% of their tenants are actually have a higher percentage of variable rents, leading to 30% of tenants in Funan being new to market brands. So overall, still maintaining accumulate on CapitaLand Mall Trust. So the rental rebates that we have incorporated into our model will reduce FY20 DPU by 14.2%, and this represents a yield of 5.9%. So currently, CMT will be trading at a price to NAV of 0.87 times, and this is relatively attractive compared to the 1.1 to 1.3 range that CMT has been trading in over the last 3 years. Moving on to CapitaLand Commercial Trust. So CapitaLand Commercial Trust, they actually own 60% of Raffles City Shopping Centre, which is the trust that holds the shopping centre as well as the hotel component and the office component of Raffles City. So some of the tenant, while the commercial or the office tenants have not really gotten much in the way of rental rebates, some rental rebates the rental rebates that were given are more attributed to their 60% stake in Raffles City Shopping Centre. So gross revenue was 3.48% higher. This was due to the acquisition of MAC, the Germany asset acquired in September of 2019, and offset by lower income from Asia Square, Tower 2, as well as 6 Battery Road. So in comparison to their retail REITs, the amount retained was actually lower because less tenants have actually come forward asking for rental rebates, and CCT does not foresee this number spiking in the coming quarters. On the positive side, 10% of leases remain up for renewal. 60% of the leases expiring in 2020 have actually been committed, and CCT signed approximately 300,000 square feet of leases in 1Q, with positive rental reversions of 0 to 31%. So on the negative side, portfolio occupancy fell by almost 3 percentage points. This was largely due to the lower occupancy at 6 Battery Road. So Standard Chartered, which was their, one of the largest tenant in the building, they actually downsized, and they gave up about 20% of space. And this was their lease expired in January 2020. So this was the reason for the lower occupancy. And then this space now will be undergoing some AEIs. So we lower our FY 2020 and 21 forecast to factor in the lower occupancy from the weaker demand in the near term, as well as the lower revenue from Raffles City Trust due to the tenant support initiatives. So currently the yield will be 5%. Our next counter is Ascendas REIT. So Ascendas, this is their 1Q update, and they have also shifted to half-yearly reporting. So rental reversions came in at 7.7% for the Singapore leases, and the occupancy in Singapore actually improved by 1.4 percentage points. So this lifted the entire portfolio occupancy by 0.8 percentage points. So Ascendas has always been relatively conservative in terms of their rental reversion guidance. Currently, even though they achieved this 7.7% rental reversions for the Singapore portfolio is higher than the mid-single digit that they have guided for. So currently they are guiding for a flattish rental reversions for the full year, meaning to say that they think in the coming quarters the rental reversions will be flat to negative. On one of the positive things about AREIT is their geographical diversification, as well as their low tenant concentration risk. The largest tenant actually only accounts for 4% of their revenue. So we feel that this actually helps to reduce the default risk in their portfolio, or the magnitude of it. So in terms of the tenants operating during the circuit breaker, 40% of their business park tenants, as well as 50% of their high spec tenants remain in operation. 90 to 100% of the logistic and light industrial tenants remain operational. So we actually, this gives us a little bit of comfort regarding the degree of business disruptions, especially for the light industrial and the logistics tenants, where telecommuting is not possible. So we are comforted that a high portion of them actually still remain in operation. So this might actually in terms of the tenant support that they require, it might be lower because a lot of them are still operational. So in terms of portfolio at risk, 15% of tenants in the portfolio are SMEs, or they are in industries that AREIT has identified as likely to be impacted. For example, aviation, F&B, retail, oil and gas, and hospitality and leisure. So this hospitality and leisure is actually a very small component. I think it's about 0.8% of the portfolio, and it's only in Australia. So basically, it's a headquarter of a travel agency. Depending on how you on the time horizon, AREIT is trading. If you're looking at the entire price to NAV history, on the graph on the right, AREIT is currently trading at average price to NAVs. So at 1.38 price to NAV. However, if you look at the post GFC price to NAV, which is the normalized price to NAV, at 1.38 times, Ascendas REIT is actually trading at 1.5 standard deviations. So while this might seem like a little bit pricey, we think that the stability due to its tenant and geographical diversification, as well as track record of DPU accretive acquisitions, justifies this premium and will provide stable FY20 yields of 5.6%. So overall, we're still quite positive on Ascendas REIT, and we maintain our accumulate. Moving on to our next counter, which is Ascott Residence Trust. This is their 1Q update. So they also have moved to half-yearly reporting. The table on the left actually shows us the operational performance of their key markets. So just to recap, Ascott actually strives for a 50-50 split between stable and growth revenue. So the 50% stable revenue are those assets that are on master lease or have some sort of minimum guaranteed income. So the MCMGI are the stable revenue, as well as the 50% in growth revenue, which is the management contracts. So these management contracts are purely driven by the occupancy and the room rates that the assets can secure. So currently, the split is more or less maintained at 50-50, slightly more to the management contracts. So in terms of occupancies, for the management contracts, they are currently operating at above break-even occupancies of 40%. So while yes, occupancies have dipped due to the travel restrictions, etc., it is still operating at above 40%, which is the break-even occupancy. This is mild comfort to us. And the reason for this 40% occupancy is the relatively high steady-state occupancy level due to the longer staying corporate clientele. So ART has also been pursuing alternative sources of revenue to shore up their occupancy. So they have had some success in Singapore, where their SRs have benefited from the closure of the Malaysian border. So some of the Malaysian workers have taken up occupancies in their SRs, as well as those choosing to serve out their stay-home notice in SRs. So that has helped bump up the occupancy in Singapore to about 80%. Similarly, one of their assets in the US, DoubleTree, New York, they have some of the first responders, healthcare workers, have also helped to show up occupancy. So for the month of April and May, that asset will be enjoying 80% occupancies. On the negative side, we note that actually 18 properties currently remain closed. Silver lining is that 11 of these properties are actually on master lease in France, as well as one in South Korea. So these have a fixed rent. And as also a few others in Japan, Belgium, and Spain. So one thing to highlight is that one of their master lessees, this master lessee operates 3 of the master lease assets under the ART portfolio. Originally, this came from the Ascendas Hospitality portfolio. This WBF operator has filed for civil rehabilitation, which is another word for bankruptcy, on the 27th of April. So as mentioned, they are operating 3 properties in the portfolio, and these are all in Osaka, 2 of which are currently closed. So they only make up for about 1.8% of ART's valuation. For the update from the management is that they have currently paid rents up to April, and there's 3 months worth of security deposits with the trustee. Sorry. ART is also in negotiations with their sponsor, Ascott Limited, as well as other operators on how to take over the operations if needed. Ascott Limited is actually also operating 8 other assets in Japan. So we would not see any disruption should there be a need to take over operations from WBF. In terms of perps, there will be some savings. These perps are callable, 250 million worth of perps are callable in June 2020. And regardless the method of whether they're going to call the perps or refinance with debt or let the coupon reset, there will be cost savings. So this will be relatively substantial. In terms of bank covenants, the only bank covenant that is at risk of being breached would be the interest coverage ratio testing covenant. ART has actually negotiated with their lenders to have this ICR testing covenant waived temporarily. So we actually lower our FY20 gross profit forecast by 13.9% and reduce our RevPAR estimates by about 20 to 30% for the full year. So DPU has been cut by 15%, representing a yield of 8% for the year. For our last counter, which is CapitaLand Limited. So for CapitaLand Limited, this is also their update. They have shifted to half-yearly reporting. The recurring incomes and fees from their investment property, this will provide stable cash flows for CapitaLand Limited. So last year, the investment property actually contributed 80% of the EBIT. So these are recurring in nature. So we view the high percentage of recurring income favorably. Diversification has helped them. So for the asset classes that are currently doing well or relatively resilient are commercial and industrial segments. And these 2 segments make up 21% and 9% of the FY19's EBIT respectively. So 30% total that are relatively still resilient. CapitaLand has a very, very strong balance sheet. They have $13 billion in cash and undrawn facilities. So we are also very confident that after China sort of lifted their lockdown and the showrooms were allowed to open again, CapitaLand actually launched one of their projects, which is Le Botanical at Xi'an. So they launched 288 units on the 24th of March, and these units were all sold out within 4 days. So we are very comforted by this this very healthy take-up, robust recovery. And we also note that actually across all the other states in China, launches, the sales price of those launches sold recently, they are higher than the sales price of previous launches. So this is a mild consolation to us that there is still relatively healthy demand for residential assets in China. On the negative side, the 2 segments that remain under pressure are the lodging, no surprise there, as well as the retail segments. As at end April 2020, 552 out of 485 properties remain closed. This is with respect to the accommodation and lodging segment. And CapitaLand's RevPAR fell by 22% for the first quarter. Shopper traffic fell by 10.8% and 52% year-on-year in Singapore and in China. So in China, all of their 15 malls have actually reopened. However, I think there's still some caution in the market. So the shopper footfall has still been relatively slow returning to the malls. Currently, 85% of the China retail tenants are operating. So the remaining percent are those cinema operators or those in the education and enrichment lines. Another negative we noted is that there is still difficulty trying to replace or replenish the Vietnam residential pipeline. So this is due to the longer approval process on the government side. So likely we will not see any more launches for Vietnam for this year. Moving on. There might be some revaluation risk in terms of portfolio valuations. However, the group still remains committed to their $3 billion recycling target for the year. And in fact, they are looking at opportunities or opportunities to pick up counter-cyclical assets or assets at a good price. So our target price is actually lower, slightly lower, from $4.20 to $3.94. This is after incorporating the revised valuations for the REITs. So and FY20 revenue was cut by 14%. And that's all for me. I will pass the time on to Paul for Sheng.
Yeah, thanks, Natalie. Move on to Siong's first quarter results. Okay, if you look at the slides, just firstly on the revenue line, it was obviously very robust jump in revenues. Revenues are up 31%, probably up unprecedented for them. But if you look at the breakdown, if you try to dissect the growth, 1/3 of it was from new stores, so that's healthy because that's more structural. The other 2/3 was actually due to same-store sales growth. Basically, what that means is that maturing store, basically your existing store, the existing old stores grew sales by around 20%, just to keep it simple. So basically, so you can see the 1/3 of the growth, new stores, and the 2/3 was just organic growth. China also did well. China also enjoyed a similar kind of a momentum in sales, basically panic buying. Okay, anyway, in terms of, then of course all this translates to a surge in earnings, up 48%. But do know that there was a government grant. So if you take that out, probably they grew about 30 plus or high 30% plus growth. And separately, sorry, it's not in the slide, but separately, as we move on to the second quarter, they're probably going to get another big jump in government grants, in the results. But anyway, let's say if we move on to the positives, the first bullet point on the top right, again, like we mentioned, the growth was the same-store sales spiked 20%. There were basically two reasons. Firstly, was better consumer sentiment. I think even before we had this outbreak, their Chinese New Year sales was already performing well. Then, of course, when you had this outbreak, you kind of turbocharged it with the first phase was everyone just pantry stocking, or a nicer word for panic buying. Then, of course, the other driver was new stores. The second bullet point, the other positive we saw from the results was their house brands actually did well. And why this is important is that house brands are essential products, and also their margins are 30% higher. If you take a step back, most of their high margins is in the fresh products, but if they can grow this non-fresh, which tend to be lower, then it will be a structural positive for them. In terms of the negatives, the admin cost, basically staff costs, jumped quite significantly. We were a bit surprised. We thought there would be more operating leverage. And the other negative is that because of this circuit breaker, they cannot sign lease, they cannot renovate. So there will be a bit of slowdown in terms of new store sales, new stores being open. If we move on to the outlook, I think second quarter will be another strong quarter. Of course, first quarter you benefited from pantry stocking. But what is happening now is that, as we all know, there's more home dining by households due to the circuit breaker. So that will continue to help sales in the second quarter. Margins, the second, number two, gross margins. Of course, house brands helps, and of course, they continue to grow their fresh products, which is the highest margins. But do note there will be a bit of some lumpiness in the second quarter expenses. On the first part, operating expenses, they're going to pay a 1-month special bonus. Well, that's great for their employees. And also then in the second quarter, but at the same time, they're going to get some job support scheme. So this will cause operating expenses to be a bit more volatile. We won't see much of a trend. In terms of our recommendation, we still maintain accumulate. We did raise our target price, but again, it's always a challenge right now. As you know, the earnings is a bit unusually strong. So we have to be a bit mindful when we put a target price. We want to put target price on so-called normalized earnings, because right now, earnings is spurred up by this outbreak. So anyway, our target price is 1.58, and also we just raised our forecast 100 million, mainly due to this outbreak. And as usual, we always peg it to 25 times PE. StarHub. Okay, the next slide. Okay, the picture wasn't so pretty for StarHub. I think if you look at the first bullet point, as you know, StarHub, although they have paid TVs, the bulk of the revenue still come from mobile. So mobile surprises on the downside. If you look at okay, let's say we go through the positives first. The positives is that the EBITDA actually still increased 9% quarter on quarter. But so what that means is that they still, although revenue came down, they still managed they are still very tight on their operating costs. So across the board, all costs actually came off, which includes staff costs, repairs, and so forth. The other positive for cybersecurity turn in a profit. Why this is important is that cybersecurity, as you all know, globally is the fastest growing business, fastest growing category of IT spend. So as a result, this swing is actually quite meaningful. But again, they did caution about the sustainability because they are still good at the investment mode. As you know, it's expensive to hire cybersecurity specialists, so they are still expanding, and their target is to be global. So they're just mindful that they are investing in this business by hiring a lot of headcount. So they're just mindful of how sustainable the profit will be. In terms of the negative, I think it all boils down to the postpaid ARPU. So postpaid ARPU basically your selling price for mobile services. So it was stable around $40 for the past 4 quarters. So they had a big drop. I think it's an all-time low for ARPUs to 34. So I think a lot of it was due to the loss in sorry for the spelling error there, loss in roaming revenue. As you know, due to this the circuit breaker and lockdown, they lose a lot of revenue in terms of inbound and outbound travel. And we always say that this is high margin business, because when you have a inbound or outbound, you have virtually no cost. There's hardly any cost when you have an inbound customer roaming into Singapore. So I think this kind of hurt them quite a bit. Of course, there were SIM-only plans, but this has been prevalent the last 2-3 quarters. The other negative, if you look at the second bullet point under negatives, is the FY20 guidance is withdrawn. I think this is important because they say it was due to uncertain environment, but management has always been quite conservative. But what it also means is that technically they're withdrawing their dividend guidance. But when we look at the outlook, we still think that they can still maintain their 9 cents dividend yield, which is basically a 6% yield. The reason why we say that is that to pay this 9 cents, you basically have to pay about 155 million. But we think their free cash flows can hit about 350, almost double this, even though of these big earnings. And also their first quarter free cash flow was already 120 million. Of course, there was a bit of delayed capex, but we still think their 9 cents is actually sustainable. We did downgrade to neutral because we did cut our estimates, and also we sustain it at 6 times EV/EBITDA. But do note that, you know, when we do a target price for StarHub, because this is under kind of depressed short-term earnings, so that's why we're always a bit wary of putting in earnings, putting in valuations when earnings are depressed in the near term. Yeah. Okay, I'll move on to the next slide. Okay, NetLink. Okay, the next slide. Basically, NetLink, you know, it's all about stability. Sometimes you find it even hard to write now because everything is just so stable. But anyway, if you look at the 4th quarter results, the red line, so the core business is residential connections. So if you look at it grew about 9%. The reason why residential revenue grew is, you look at the second, it's not in red, there was about 1.427 million residential connections. So this is the most important number when you look at NetLink troubles, because what they collect is, you see that 1.427, which is 1.427 million. So every month they collect 1380 from all of us. So that 1.427 million connections times 1380 times 12 months comes up to almost 200 over million, or 230, 240 million. So that's the core of the business. And what you see is that the residential connections, the first positive, rose 7.5%. Don't expect this kind of growth. I think what has happened, if you all recall, as StarHub disconnected their cable, a lot of them migrated to fiber, and of course that was a windfall for NetLink. So the other positive was that they did grow their full year distribution, 3.5%. And the payout was about 200 million, roughly covered by their free cash flows. The negative, which is I think the main one, is the ducts and manhole. This is about 8%. I think what has happened is that Singtel is not using much more of their ducts and manholes. They're probably building their own. And also, these are for their old copper cables, which is being less used. In terms of outlook, I think nothing much to say. They are relatively unaffected. I think the parts that are affected for them is maybe construction as they install new residential connection, but that's small. I think that's less than 2% of the revenue. And the other part of the revenue, a bit more nuanced, a bit more unique, is that they got this thing called diversion revenue, which I think 5-6%. What happens is that whenever there's some road works, you need to divert you need to basically dig a hole in the road and then move the cables. So that's diversion revenue. So that of course will be affected to a certain extent. But again, all these are temporary and we're not really moving our numbers. So they are relatively unaffected and we think they will keep their dividend yield. So in terms of the recommendation, we upgraded to a higher target price, a bit more technical because we moved our terminal values a little bit, and we still find it attractive because they are earning that, like we mentioned before, recurrent revenue from the monthly subscription, and they are paying about 5% yield. So if you want stability in this type of environment, this is the stock for you. Yeah. Okay. Next slide. Okay. As you can see from the table, the numbers, this is as much as we got from them. The last bullet point, as you can read from the note, what they gave was just 5 slides, and there was no briefing, no detailed discussion, just 5 slides, and take it as it is. Okay, but anyway, based on the numbers that they gave, the first quarter was down 27%, and of course, profit was also down 33%. In terms of the positives, the PBT margin actually held up reasonably well, despite the drop. I think if you compare their margins to 3 years ago, it was actually even higher than that. Of course, the last 2 years, they was exceptionally high. So even though the revenue dropped almost to 250 million, the margins still held up pretty well. So that was a positive. The other positive, the second bullet point, is that the net cash was 852 million. So this is an incredible amount of money, and it's the record level for them. The search, if you want to go to more details, the last quarter there was some lumpiness, and the surprising thing is that they actually grew cash so high, even though they were actually the inventory actually jumped 100 million quarter on quarter. So that's a positive. Again, the reason why you see the poorer numbers is that there was a disruption in China, as we all know, and also the Malaysia. I think Malaysia hurt them more because of the lockdown in Malaysia, and what has happened is, as we all know, most of their operations are all in Malaysia. So with the lockdown, they virtually cannot operate or operate at very low capacity. Okay, if you move on to the outlook, okay, I'm just quoting what they did from their so-called 5 slides that they gave us all. They mentioned that the positive is, or the outlook is that by end April, most of the operating entities are working as usual. It's back to norm, back to usual capacity. So that's a positive. So May, June, you get the full, we're back to normal May to June to a certain extent. Okay, and anyway, in terms of our view, we still maintain we did drop our target price, and as we cut our earnings, but we still like this. We still like this stock. I don't know why the bullet points are not here. We still like this stock. If you read our report, again, some of the reasons is that they are benefiting from the outsourcing from China to Malaysia, plus also they're taking market share and they're paying about, I think, a 5% plus dividend yield. So we still like venture despite this temporary disruption in production. Okay, this is our last part. This is our weekly updates. So week 20, in terms of the macro numbers, visitor arrivals was a calamity. I mean, if you look at, we only had about 239,000 arrivals in March and 1,500 from China. That's to give you some perspective. Usually we get like 1.4 million per month of arrivals into Singapore. This dropped to 239. The more incredible number is from China. We used to get 250, 300,000. Basically, we get like 10,000 arrivals from China every month. This dropped to, I think, a couple of hundred. Okay, so you can, I think you don't have to do a chart. We know it's like almost like a 99% drop. In terms of retail sales, sorry, it's a typo there. It's not April, it's actually March. So March numbers were down 10% year on year. Supermarket sales, I think, as we saw in Sheng results, was up 36%. Surprisingly, even furniture was up. But I think eating places, as we all know, is down, and it's going to be bad for all the retail companies. In terms of the last macro point that we want to talk about is the unemployment. The out of US, I think this is flagged all over in the newspapers. But unemployment is it's a real big disaster in the US. Unemployment hit almost 15%. It's the worst in history. And if you and there's actually 5% that could have been added into this 15, so to hit 20%. Because in their survey, they actually exclude people who were still working, but technically supposed to be working, but they were just absent from work due to the outbreak. And of course, non-farm payrolls fell to the 20 million, the worst ever. We'll show some charts later. In terms of our tactical view, the market is still moving because I think, as we know, economic data is lagging. I think every economic data you look right now is going to be miserable and horrible. But I guess, like we mentioned before, the lead indicator is going to be how the virus develops. And, predicting the market, as we mentioned, is virtually predicting this virus. The only positive is that the new infections are plateauing, but it's not actually falling. We'll show a chart later. I guess one last point for me is that the difference why the economic numbers are so horrible compared to the previous cycles is that this time around, both services and manufacturing getting hit. If you look at the last cycle, usually manufacturing get hit, but services is pretty stable. But as you can see from the US kind of unemployment, retail and even healthcare is getting hit. Yeah. Okay. In terms of the weeks ahead, I think these are all just Powell speech and so forth. Then the last point, we are having some webinars. So you can log in through our poems link if you want to sign up for some of them. There should be one more on APTV. But if you want more on NetLink Trust, they should be coming up on 5th June. Just go to our poems website to sign up. Okay, this chart, which is this is basically the new COVID-19 patients globally. We get this from WHO. It's not a very good. It's good that it's flattening, but it's not sliding down like what we see in China or even in Korea. So and this is a bit alarming considering that we are actually opening up we are opening out a lot of countries or removing some of the lockdowns. So we worry that once you remove these lockdowns and these things start to spike again, then it won't be good for the market, because then what it means is that you cannot lighten this lockdown. The lockdowns have to come back on again. So this is again a quite important chart to monitor. Nothing much, just to show how miserable retail sales is, and this is a 3-month moving average. So if you take the latest number again, sorry, it's not April, it's March. It's actually down 10%. So that we probably have to scale down the chart to not -10, not -8. Yeah. And it's really like bludgeoning. The retail sector was really quite weak, and this kind of makes it even more horrible. Unemployment, I think the only thing to mention about this chart is this is from 1948. This is just post World War II. This is since the data was all collected. It's the worst unemployment in history since the Great Depression. This is the last one for us. As you know, we have a model portfolio. Again, sorry, this chart is a bit noisy. Just to try to cram everything inside. If you look at the table on the left, as you know, this is the top 10 stocks. So we've got Ascott, NetLink, so forth. So this is the performance. Most of it bounced back except Frasers Centrepoint Trust. The top right-hand corner is just to have a glance at the performance. I guess it helps that we outperform STI, but again, we're still down, so it doesn't really help that much. It's supposed to be absolute return. The bottom is the performance of all the various sectors. I think no stranger, we all know transportation is the worst hit, like 33. Comfort is in there, SIA. The REIT hospitality, like Ascott, all these hit the worst. This is mainly just for your reference. I'm not going to comment much. Sorry, it's not as at 30 much, it's as of April. Okay, I think that's it. I think we can take questions right now.
Okay, so this week, I'll be taking some of the banking questions, I think posted quite early on. So there are 3 questions. I think they're all pretty related. I'll just answer them all together. So first of all, there's a question on whether we should expect growing bad loans among Singapore banks as more businesses fail due to the COVID-19 pandemic. So how bad do I think the bad loans will reach? So as of right now, what we are doing is we are also getting guidance from the banks itself, and most of the banks have guided for 50 to 60 basis points in credit cost itself over the next 2 years. So in this sense, in that sense, right, we cannot, that's the best number. That's the best guess number by the banks itself, and it is hard for us to know how it will turn out as we move along. But the main thing to note is that most of them are more worried about FY 2021 as compared to FY 20. I mean, ultimately, FY 20, the first quarter has already passed, and based on top line numbers in terms of business momentum, we can see that all of them are still doing pretty well. But and because now we have all the loan moratoriums that ends either in September or December, so a lot of the loans that have not looked bad will start looking worse in 2021. So that's why the banks have already started this preemptive approach. You see them taking on allowances. It doesn't really mean that their non-performing assets or non-performing loans have actually gone up, but it is in anticipation of these loans getting worse as we enter into 2021. So hopefully, as these business momentum start to taper off, they can start to build more buffer during the next 2 to 3 quarters to tackle this impending failing of businesses. Yeah. So, and also of the banks itself, what we see is that DBS and OCBC haven't really taken into account the government measures that are put in place, whereas UOB has tried to model in some. So in terms, that's why you can see also more of the allowances were taken for OCBC and DBS in this quarter itself. There's also another question on whether DBS or OCBC, like, which is the best. So as of right now, my personal take is that what we feel is that in terms of business momentum wise, we see that DBS is the strongest. It doesn't really mean that the next few quarters they will continue to outperform the market, but this gives them a head start. You see that they have $500 million more in top line for this quarter, and hopefully this will help to build some buffer where as they cater for, they can be more aggressive when building their when they build up their capital buffers for the non-performing loans that will come up in subsequent quarters or the next year. So yeah, right now I think we are still preferring DBS. Also, another point to note for DBS is that they are announcing dividends every quarter. So this is something that as investors we can all monitor much closer as and when, because if they have any changes to their dividend policy, it is more prompt in updating. Whereas for OCBC and UOB, you need to wait every half a year. And then if the first quarter or the third quarter, the results come out and they say that, oh, they want to do some adjustments, they also won't tell you how much adjustment they will do, because they will probably take into account the second quarter or the fourth quarter results before determining how much they'll give for every semi-annual. Yeah, so in terms of monitoring wise, yeah, DBS is also slightly better at the moment. Yeah. And I think there's also another question that is, please do a similar comparison on DBS. If you really want to compare all the 3 banks put together, I think generally what we are seeing is for DBS itself, definitely business-wise, it is still doing well. The slowdown, of course, hit all 3 banks equally, but like I said, it puts DBS at a better position to hedge or to put more capital buffers in upcoming quarters. And for OCBC wise, hopefully the oil and gas is really isolated incidences. We don't really see the oil and gas underperforming the market too much, though. So their impaired loans won't rise too quickly in that sector. Then OCB and as well as the Great Eastern yeah, it will continue to make a lumpy contribution to OCBC. So that's something to take note of. And for UOB wise, generally we see business momentum has already started dropping off. But in terms of capital position wise, right now, so DBS, if you really want to take a pure comparison, DBS has about 3.2 billion in buffers. Both OCBC and UOB has about 2.3 billion in buffers. That is for general provision. So as and when, if more and more loans start turning non-provision, it will actually flow into this. The GP reserves will go down, and then it becomes on the bank's initiative to add more into their buffer. So it won't be, it's a 2-step process instead of a 1-step process whereby they just come into their P&L. It will go through their buffers, and depending if they want to take on more through their P&L, they will need to take on out of their P&L to cater for it. But as of right now, all the non-performing, the NPA coverage. So how much of their non-performing assets are already covered for. We see that for DBS is about 92%, and for OCBC and UOB is all at about maybe, I think, high 80%, so 80-89%, something like that. So in the short term, definitely the NPAs won't start hurting them very greatly, and they can all still hit their payout ratios fairly decently.
Hi, okay, I have quite a few questions with regard to the REIT sector. So perhaps I will take the question on, hold on, let me find it. Okay, I think that I saw one question asking about the asset valuations. Will there be any downward revaluation? So I think for that one, valuation is a three-factor kind of model. So it incorporates the present value of the cash flows, which is the rents that can be foreseen to be received. And then it also takes into consideration the current selling prices of comparable assets, and also the capitalization rates of assets, comparable assets. So in terms of the present value of cash flows, while we do forecast that there might be a bit of downward pressure on rents and rentals, so that means probably that part of the equation will be slightly lower. In terms of transactions in the market, there haven't been a lot. I think there haven't been a lot of sales. So I think most investors are actually adopting a wait and see approach. So sellers currently, there are not a lot of sales, and in terms of buyers, they are still trying to suss the market and wait for valuations to drop. So in the transaction respect, there hasn't been much going on. If you're looking slightly long term, while there might be some distressed sales, there may be some distressed sales, but I think mostly valuers will actually disregard that. And I think broad picture, there might be some downward revaluations, but I don't believe that this will be a very significant portion. There was also some other questions, if I can find it, hold on whether or not we incorporated the weaker rental or weaker retail sales in our forecasts. So the answer is actually yes. So we cut our forecast for the future years as well. This is mainly from the lower retail outlook, so the lower rental reversions, etc., and occupancies. In terms of tenant sales, actually for retail malls, CMT and FCT, the turnover portion, tenant sales, right? They only contribute about 5% to the gross revenue. So most of it will actually come through in terms of the rent itself. So for this year, in my forecast, I have lowered the amount of turnover sales that is expected, but do believe that there will be some recovery in tenant sales in the future. So I will pass on the time for the rest of the team to take some questions.
Yeah, we have one question. Would you suggest to wait for second quarter results to come out before going to a market, as first quarter was skewed by Jan-Feb results? Okay, our tactical view is from now until the second quarter, the market could be really range bound. I think firstly, what is happening is we see all these lockdowns easing, but at the same time, no government is going to announce any fiscal stimulus. So everyone is just watching how the unwinding of these lockdowns turn out, whether there'll be another round of infections. So my own guess, I mean, this is like 1-2 months, right? So my own guess is probably it could be a bit range bound market. If I have to go in, I would probably think the retail REITs would be a bit more attractive. I think because as we are removing some of the lockdowns in Singapore, I think market might kind of do a short-term re-rating that the worst is over. So maybe retail REITs is more like a risk is over trade. for a lack of a better word. So anyway, just to go back to your question, would you wait for second quarter? Perhaps I would, but it's all about how the COVID-19 situation develops. But I guess in a nutshell, I would. Dear team, which REIT sector fell the most during the pandemic? As you can see from this slide, this one I can answer objectively. I can see from the side, the number 8, REIT hospitality, I think that dropped about 32%. So I think that is the obvious one, because the hospitality REITs are the most heavily affected by all this. Do you think Singapore turnaround has? Well, this one's a bit. This is a bit of a. I did listen to their conference call, but a bit tricky. Really not. Of course, they've been hit. I did listen to the conference call. They've been hit really badly during this outbreak. I think volumes plunged, number one. The most important, the ad mail also disappeared because nobody's going to advertise anything. And then the labor costs kind of spike up because they need to keep the Malaysian employees. So they're being hit by almost, they were already down, and then it's like kicking the guy already on the ground 3 times. So we think things have bottomed, but in terms of a turnaround, structural turnaround, we're really not sure. But in terms of bottoming up, possible, because this is like the worst kind of scenario you can get. Like I said, volumes down, your costs increase, and your revenues all collapse. Sorry, because we don't really cover, so this is the best I can do. Apologies for that. What is your view on AEM after the recent run-up in price and sector in general? Frankly, we, like I mentioned before, I always listen to AEM results briefing. I totally don't understand the product, so sorry I can't help you then. If you can answer any, you come in, Natalie. But I'll just run through. Hi, Paul. Currently, STI seems to be trading range. Do you think there'll be another drop to retest the March 20 low in the weeks ahead? Again, this is more like a COVID thing. If the outbreak worsens to a new high, then I think we will touch the new low. But if not, I don't think a new low or the kind of the virus kind of mutates into something worse than people expected. I don't think that we could test a new low. And considering the market action, if you look at how the market's reacting to all the negative news, it seems to be ignoring all the bad news that comes out. It tends to be ignoring it. So I guess in terms of market action, price action, sorry, it's kind of positive in that sense. So long as the lockdown comes in, there will be a second wave, and if the second wave isn't, we don't see globally a big spike, I think we probably way past the lows. I mean, this is just my own views, because as we mentioned before, in the background, we got like record low interest rates, and records fiscal stimulus by governments, and they're ready to pump even more if the situation worsens. Yeah, I mean, these are all tactical views. Yeah.
Okay, I will take some questions as well. I think there are 2 questions from OCBC, I think. Okay, so there's an interim judicial management application for Zenrock. Is going to impact local banks or lead to greater issues in the oil and gas industry. Okay, so as I mentioned during my OCBC slides. Okay, so yeah, basically Zenrock is the next big name that everyone is looking out for, but their total exposure to lenders in total, I think generally there was six of them marked out. So total exposure to all 6 is about 200 million, with HSBC being about 50 million. That was what I read on the report. So if I believe the 6 lenders that were exposed, only one of these local bank, which is OCBC. Yeah, so for OCBC, they did mention as well, probably the SP will appear in the subsequent quarter, so the upcoming quarter, so second quarter results. I don't really think it will be a very big part as the Hin Leong impact. So yeah, I don't think, and they did say that it should be an isolated case, but for the entire oil and gas industry, generally what is hit the most when the oil price crash is actually all the traders. And I think the banks itself, the traders wise, they're all limiting their exposure to the traders industry. And for the OSV, which is the offshore marine vessels, all these have already been marked down in 2016 and 2017. The remainder that has not really been marked down are all very maybe like state-owned enterprises, overseas state-owned enterprises, and large multinational corporations. So generally, they don't they actually want to do more business with these big companies. Ultimately, they feel that credit quality wise, they are among the top in the entire world. So definitely there's something to look out for. And for the next question, I think there is one on OCBC having a franchising system in China, and how is it working as far as bad loans is concerned. Okay, I'm not sure how the franchising, I didn't really hear much about it, but they did mention about their Wing Hang Bank in Hong Kong, Greater China area. So generally, there will be some savings coming in from the Wing Hang side in terms of their risk-weighted assets, cause of some currency translation effect. So it will give them some savings in about $7.5 billion in risk-weighted assets. So that's something to look out for. It will actually help them bolster their CET1 by maybe a few basis points. So that's something to look out for. And as of now, generally for all three banks, regardless of OCBC or is it like UOB or DBS, generally their China portfolio, the non-performing loans ratio is much lower than it is as compared to the whole market, their whole business. So generally it hovers below 1%, whereas their actual non-performing loans ratio usually is about 1.5, 1.6% now, and is expected to deteriorate to about 2%. But for China, usually they are more prudent and make sure that it's more high quality as compared to other countries. And I think there is one on SGX. I'll take the one on SGX, whether it still have some room to go up. Okay, so for SGX, actually our model, okay, my last target price for SGX, I think is $9.24. But because our model, we take into account one standard deviation below the mean when we calculate the PE ratio to, the PE multiple that it will be trading at. If I were to look at it like based on mean, I think it will reach about, let me calculate, just give me a moment. Okay, sorry. So yeah, if I were to look at just the mean alone, so currently we see actually SGX is trading higher above the mean, but we were just to look at the mean, my target price will have been revised upwards to about $9.70. Now it's about $10 already. So yeah, I'm guessing based on the current PE ratio that it is trading at, yeah, that's the value that you're seeing in the market right now. So in a sense, it can run up, but the room to run up more is much lesser. As you can see, all the fresh money that they experience in the first quarter or their third quarter results actually has already been priced in, and we don't expect much more fresh funds to come into investing to boost their volumes anymore.
Yeah, we did get some questions on entry price and exit price. I think our chartist Viren has answered, and he later on 1 o'clock he has a usual webinar. So if you want to attend that, you can also ask. If you have any technical questions, you can always ask him in terms of entry exit points.
I'll answer a question on ComfortDelGro. So ComfortDelGro currently not advisable. I mean, that you mentioned that what is the entry and resistance price for ComfortDelGro. I can give you the straight answer is, let me pull out the chart. Okay, but as for ComfortDelGro, is currently forming a bearish flag. So I would say that the resistance is currently at 1.65 to 1.70. Not advisable to go long, but if you want to go long, you can try at 1.42, which is the immediate support level. Hope that answers your question. Thank you.
Yeah, we have a question. Can you gauge the effect of circuit breaker on SBS Transit? We don't have an exact model on SBS Transit, but as you know, the large part of it, the bus business shouldn't be affected because they are paid to drive the routes, even though there could be nobody, no passengers. They can just drive around and still get paid. The MRT business will be affected because they take passenger risks. The only caveat for this comment is that we're not sure under this style of situation how the contract terms are designed such that they are actually paid less because they drive the buses less. Because the problem with this style is that we don't get privy to a lot of the contracts. So how the contract terms are structured is what the company tells us only. Otherwise, there's no other way for us to gauge the how this contract especially for the buses are actually designed. But in general, they shouldn't be so affected on the buses.
Hi, so I will take the question on Funan and CapitaLand Mall Trust. So I think the question was, why are there many analysis reportedly quoting Funan Center as a focus contribution? I think this is because, actually based on my forecast, Funan will contribute about 8.6% of revenue for the year. And CMT's assets are actually quite nicely distributed. So several of their assets actually contribute 9% as each to the portfolio, like Plaza Sing, Bugis, IMM, as well as, if I'm not wrong, it is Tampines Mall. So in terms of asset distribution, is very even. So I think the reason why the focus of Funan was actually flagged out was because it actually, the acquisition of Funan actually helped to grow revenues year on year. So that might give the appearance as if the revenue has grown, which actually it has, but on a same store basis, it was actually down by 2.2%. So I think that was why it was highlighted. In terms of, we have another question with regard to CMT and CCT. How would the merger be positive for retail investors, and what would be the influence on share price, dividend yield, etc.? So for the merger of CCT and CMT, actually, I think it is a matter of eventuality, because there is some overlap between the two. For example, CCT, while they are predominantly office portfolio, they also have a stake in Raffles City Shopping Centre, which we know also is part of a shopping centre as well as a office tower and a hospitality block. And then we have Funan, which is also a retail mall plus office tower, and there's also a lift, which is not actually part of the Funan asset that is under CMT. So in terms of, this is more of a, I think this is a growth story when these two malls combine. So it will actually allow them to acquire or hold more integrated assets. So eventually they might actually be able to purchase some of the integrated developments in China, like, you know, your Raffles City. There are several Raffles City integrated developments in China. But I think the management has actually also commented that in terms of geographical breakdown, this CICT, the new merged entity, will be 80% in Singapore. So yeah. So I think it's more of growth. In terms of CMT, there were growing pains, as in there were not a lot of malls left for CMT to acquire. And for CCT, it will give them more agility, because the capital value of office assets is very significant. So every time they want to take on an AEI or reposition or upgrade an asset, it will take the impact to DPU disruption will be relatively significant. So as an enlarged entity, it will actually help to even out the cash flows. Yeah, so that will be the positive. We also have another question on land lease. So someone was asking, referencing DBS, land lease being DBS's top pick, and what are my views. So I will give my thoughts, and then I'll want to Jie to also give her 2 cents worth. In terms of land lease, I think probably one of the reasons for DBS calling it as their top pick is because of the recent share price movement. Currently, I think it's about 34% down from where it was trading pre-COVID. However, in terms of selective stock picking, I would prefer a stock that has more than 2 assets, and also more of a growth story in a sense. Yeah, so that is the reason why currently land lease is not really on our radar. Can I say that? Okay. I'll let Jie give her 2 cents worth.
Okay. As Natalie mentioned, this portfolio only has like 2 properties inside, and then one is commercial and one is retail. For the commercial part of it, it's actually 30% of the gross rental income contributed this quarter. So like for this part of it, it's actually the defensive portion of the portfolio. But then, so you can tell the remaining 70% is actually the retail side of it, which will be very, which might be very heavily dependent on how the COVID situation actually unfolds from now on. The management also actually guided that like the retail sales for next few months will be slower, that's for sure. Yeah, so as of now, we don't think that land lease will be a good counter to look at, but because land lease also did mention that land lease global commercial REIT will be the only REIT that will be land lease group will be having. So you can tell that like with such a sponsor backing a REIT, in the future it might actually be something for us to look at, but not for now. That's all from me.
Yeah, okay. I think we are running short of time. So sorry. I know there have been still some questions unanswered. If we keep on staying, I think they're going to kick us out soon because there's another webinar. But I really hope everyone can, as you know, we have a website. You can actually post some of your questions or email us. We will try our best to reply to you. And sorry we didn't. Really sorry we didn't answer some of your questions. We'd like to, but just that I think we're going to get kicked out soon by the webinar host because there's going to be one more hangout. So anyway, thanks everyone for attending and stay safe. Just send us an email on any questions that you have or through our Stocks BNB, the commentary section. We will try to answer for you. Yeah, thanks again for attending. I really appreciate it. Bye bye.